So welcome everyone to our first 2024 quarterly webinar. Per usual, Adam will review major asset class returns for the year. As we all recall, Woody's had a strong finish to the year, which created a strong full year of returns. But we'll see that those returns actually were very concentrated in just a handful of stocks. Bonds also had a nice rally at the end of the year, which salvaged what could have been two consecutive really dismal years for fixed income. Iowa just took place. New Hampshire's coming up. South Carolina. I think we're going to find as the year goes along that the election news will sort of shove aside inflation as the center stage act for investors. There's going to be a lot of strong emotions around this Biden-Trump rematch, and the media will do all that they can to hype that emotion, but we'll review some evidence that shows again that historically, who's running for office and who wins the office actually is not particularly relevant to how we're going to do as stock market investors. How we position accounts with respect to size and style, those are the most consequential two decisions that we make. So Andy will spend some time explaining our rationale for our current positioning. And then finally, he'll review the rating effectiveness that we had last year. During recovery periods following major market declines, that's when we performed the best, and last year was another case of that. So Adam, I'll turn it over to you.
Great. Yeah, and real quick, Lowell, before I dive into the markets and the economy, just as a reminder for everyone who hopped in the last couple of minutes, we're going to do some Q&A at the end. So if you scan this QR code now, you'll have access to entering questions, directly that'll directly feed to us, and you can also use the Q&A function in Zoom. So we'll aggregate those as we move along, and then we'll tackle them at the end. So real quick, and as Lowell stated, you didn't have to pay a whole lot of attention to what was happening in the financial news to know that we closed the year really strong across the board, across asset classes, and globally in the markets. And when you go back and you look historically at annualized market returns and calendar year market returns, it's easy to pinpoint a year where you saw a double-digit decline and say, wow, that must have been really nice and easy. But last year was just a great example of returns not happening just in this nice, pretty linear fashion over 12 months. It was a volatile ride, and for a good chunk of the year, the market was at many points flat and not up much at all. But we had a really a whole lot of wind behind our sails in Q4. Most of the equity asset classes up double digits, with real estate seeing the biggest rebound, which makes sense because REITs in general got hit the hardest as rates were going up in 2022 and into early this year. And the bond market, last year in 2022, in long stretches, bonds were neglected and historically selling off, and a real eyesore for a lot of portfolios. But to see bonds essentially in Q4 post what they typically do on an average calendar year was really another good reminder that market timing is hard. Things happen in unpredictable fashion. And so, just in general, a lot of easing concerns about inflation, the idea that we're going to start cutting rates this year, not raising them anymore, and the idea that the economy avoided largely the recession everyone was predicting was the main driver of a really a strong, year-end rally. And if we zoom out a little bit over the past few years, a lot of these trends have just continued. It's amazing to think if we go back to 2018, we've really had 3 bear markets in a 4-year window. And so you think about a bear market being a sell-off of 20% or more, peak to trough. We had that from, in 2018, 2020, and then in 2022. So there's been a lot of, stretches the last handful of years where pessimism took front and center. But to see those kinds of sell-offs in such a tight window has tested a lot of investors' resilience. But again, if you trend back, things have been relatively well above average through the last 5 years specifically. Andy will talk about where that's predominantly happened, especially in the context of last year. But 2023, the main story really was investors and economists and strategists not seeing eye to eye on the direction of the economy and the markets. We in our fall webinar we posted some statistics. Bloomberg did a big piece early last year that said something like 85% or almost 90% of economists were predicting a recession in 2023. There was, if you look at sentiment measured at the institutional or the consumer level, everyone felt really negatively about everything coming off of 2022, in which we saw a 20% decline in the S&P 500. It was so much easier to be negative than it was to be optimistic. And when you see those statistics that they put out there, hey, here's what the market returned over this window of time, and here's what the average investor did. There's always a big delta amongst those numbers. And I think last year was a classic example of where it would have been so easy to play defense, to get out of the market, to be really cautious and hesitant. And you probably on paper would have had a decent case of doing that. But again, there's a lot of investment surprises to the negative, but also to the positive side. And that was a big year for a teaching moment. And I think the key themes heading into this year, first and foremost, the economy is still strong. So that recession that we've been predicting, as a whole in the markets, it just has not materialized. It doesn't, although the economy is slowing down, it doesn't lead to any kind of indicator at this point that you're going to see a recession anytime soon. And this morning, a great example, we got a recent update from December on how the consumer is doing, and they're still just as strong as they were, through most of last year. So people are in a solid financial position. They're spending money. Profit margins are still really strong, and so more likely than not, things are lining up for people to start feeling even better about rates coming down through through the year. Some of the volatility will probably be caused by the questions surrounding when are they going to start cutting and by how much. Just like we saw predictions as rates were rising, we're seeing predictions about rates falling and timing. It's completely natural for that to cause some volatility. But all in all, once that gets behind us, people will still feel good about the direction of the economy and the market. So as Andy's going to point out, last year specifically was incredibly concentrated in terms of where these returns came from, and I'll give you a dose of optimism about that broadening through 24. And what's definitely going to come on our radar sooner rather than later is the election. So we wanted to touch on some data points. We started talking about this halfway through last year because every election cycle, we know, regardless of how hard we try, it's going to be atop a client's mind. There's going to be questions and concerns, regardless of political beliefs or affiliations. And there's a degree of sensationalism that comes along with talking about elections and promises made and what people think a president may or may not do for the economy. But two data points I wanted to really highlight was going back, historically through various election battles we've seen over the past, almost 100 years. What has the market yielded in the years before an election and also during an election year? So in and around when an election is happening, what tends to be the average market behavior? And you'll notice at the top right, if you just wanted to know what's the bottom line, you'll notice that markets tend to fall right around their averages, regardless of whether we're in an election year or a year before an election. There's certainly extremes to this. If you go back, there's a couple that just point out, if you just eyeball the chart, you notice we've had some rough recessions the last 90 plus years, and some of those have hovered around election cycles. But all in all, you'll notice no major significant deviation or nothing really special about a pre-election year or an election year when it comes to investing and market impact. And then next, it's like, well, what about when we get on the other side of the rainbow after an election? You know, when you look at various administrations, different political parties and presidents going all the way back around the same window, almost 100 years here, you know, how has the market returned during these various administrations? With the average on the top right, you'll notice that none of these seem to look or feel much different. You see numbers that largely replicate what we can expect equity markets to return over long periods of time. We also see a couple of anomalies, but the key question we really need to ask ourselves when we hit election season is, how much does this matter as it relates to the performance of our investments, and specifically that only? Outside of our day to day and other things that we might feel passionate about being a separate conversation, but how much control does any single administration really have over market movements? Certainly in, you know, 1 day, 1 week, 1 month windows, there could be volatility, but over time, markets tend to overlook administrations and focus on the other unlimited number of inputs that the global economy can have on the investment world. So this is just a small, you know, hopefully point of comfort as it comes to what you might be hearing in the next several months. But as I said before, we know this is top of mind, and this is something we're going to work hard throughout the year to provide, you know, research and educational insight, especially as we get closer to fall of this year. So Andy, I think that's wraps up my piece there. If you're ready to talk about the size and style in the equity portfolios, I think we still got you on mute.
There we go. Thanks for the heads up. We were just talking about how it's been so many years of this the Zoom thing, and we're all still figuring it out as we go. But thanks for running through all that, Adam. You know, certainly that's a great high-level overview of what different asset classes have done, and it's a good way to set expectations as far as what to expect as elections become, or the election in the U.S. becomes a more dominant storyline. But I want to take a minute to dive deeper into the U.S. equity returns that occurred last year, because I think there's some really interesting things that happened that are very different from what our expectations will be moving forward. So I don't think you can recap 2023 without talking about Magnificent Seven. And, you know, if you haven't heard that phrase, good for you. You probably haven't been watching too much CNBC, and I think that's a good thing. But it's basically the 7 largest companies in the U.S. stock market are, you know, the big 7 tech players that you would expect on this list. And they have risen to be just enormous in size and enormous in weight in market cap weighted indexes. So one of my favorite little fun facts that you might be able to go and tell your friends or family about is the S&P 500 returned 26% last year, and the S&P 500 returned 14% last year. I'll give you a minute to think about that. You know, I basically said the same thing, and both, it seems like both those statements are contradicting each other, but in actuality, it's true. So there's 2 different versions of the S&P 500 that own the very same stocks. There's the version that weights everything by the size of the company. We call that weighted by market cap. And that is the index that produced 26%. But another way to construct that index is take the same 500 stocks, but give each one of them the same pool when you calculate returns. And that's the number that gives us the 14%. So that 12% delta between those two is historically massive. And there are times this year when it was as high as 15% of a differential between those two indexes that are essentially the same thing. They own the same stocks, they're just weighted very differently. And the reason is we've seen these stocks really balloon in size. It was a big storyline in 2018 when Apple became the first company to cross $1 trillion in market cap. Now we've got 5 of them. Apple itself is nearing 3 trillion at this point in time. So you can just see that they're massive, massive companies. You know, they're right now pulling anywhere between 25 and 30% of the overall value of the S&P 500 is just these 7 stocks. So that's a huge number. So you can see that they have outsized influence on any sort of market cap weighted index. And when this subset of stocks do so well, it's really going to be sort of the only game in town for a while. So you can see that some of these numbers are eye-popping, like Nvidia over 200%, Meta, which is, Facebook was almost there, and even, a 48% return. That was the worst performer from the very biggest one of these stocks. I mean, those are outstanding returns in a given year. So when you look at the concentration, though, that this presents, there were times this year where it was basically just these stocks that were accounting for all of the returns in the stock market. So there was this really narrow breadth for much of the year, especially when we look back in the spring. And you can see that when I roll over to the next chart here, when we look at where performance came from within US stocks. Anything that was exposed to those Magnificent Seven did well. So look at the NASDAQ. That was the best performing index last year. Look at that large growth group of stocks, which is where most of those big players live. I mean, these were the best performing groups of stocks, and really at expense of anything that was smaller in size. So when you look at the Russell 2000, that's the small cap index. That was the worst performer, right down there actually with the Dow. But that was the general trend was the largest companies did very well, and it was more of a struggle as you went down the size spectrum. So that's a trend that is probably true for the year-to-date number. I think interestingly, when we look back at the end of year rally that occurred last year, so we kind of had a swoon at the beginning of the fall, and then November and especially December were really strong months for the stock market. And there were really strong months for everything. Magnificent Seven did well, but there was even stronger performance from smaller companies. And you can see that in that column where we look at the 1 month number. The smaller companies ended up doing better than the larger companies over that shorter term window. So we're beginning to see a broadening of returns, and ultimately, I think that is a healthy thing for the stock market. If it's only going to be 7 stocks that are pushing the market higher, you'd like to see the returns come from different industries, different companies, and we're beginning to see that as we went into the end of 2023. Another way to look at this is look at large cap stocks. Large cap stocks, by and large, have made back their gains that they lost during the 2022 bear market. And sort of a weird quirk is typically when we see a recovery in the stock market, it's small cap companies that are leading the way. But the yellow line on this chart represents the Russell 2000. And you can see that small caps simply did not, do much of anything for much of 2023. It was really that end of year surge where they were beginning to make progress back to break even, but there's still quite a ways to go for small caps to fully recover the lost ground that occurred, from the very beginning of January 2022. So when we look at stock market returns, S&P 500 up 26%, sometimes people say, okay, well that was a great year in the stock market, but how much more can we really expect as far as returns? And that may be true or may not be true amongst the large cap group, but there's significantly more room to run, specifically amongst the smaller players that are beginning to see that momentum kick their way. And so since small caps lagged during the recovery, which was atypical, that begs the question of, it's great that they had a rally. Was it fool's gold? What do we expect? And as Lowell mentioned, the main thing that we do with our U.S. equity strategies is we try to play the size and style market phase that's going to be in favor. And so we typically show this chart. It shows what was in favor over the rolling 3-year time frame. When we're in blue, small caps are doing better. When we're in gold, large caps are doing better. You can see that we just went through a pretty substantial period where large caps held the performance edge for the majority of the period, but that large cap momentum has been waning. And so the way that this chart projects is the trend tends to continue. I call it the wave chart because the waves kind of they ebb and flow. And right now we're seeing the momentum when we look at this longer term time frame pushing us towards small caps outperforming. So when we take a long view in terms of what we expect to outperform moving forward of a year plus, we're expecting small caps to be in favor, but certainly that doesn't always have to be the case. And we do look at shorter term signals. So I'm not going to try to describe what we're doing here. Basically, we're looking at moving average signals to tell us what is doing well right now. And when we look at that signal, we see that there's agreement between both what we expect the long-term trend to do, which is to go pro small cap. And due to that end of year rally, we're seeing really strong pro small cap momentum in the short term as well. It may have peaked a little bit there before giving some back at the very beginning of this year, but by and large, when we see this line above the origin of zero, the expectation is that small caps will continue to do well. And when we add a third thing to that, we look at valuations. Valuations are, I think, interesting context, but there's the saying that the stock market can stay irrational longer than you can stay solvent for a reason, and it's because sometimes we can have these huge, valuation discrepancies that last for long periods of time. So we don't like to look at valuations in a vacuum, but when we pair the valuations with the momentum, we can make a really strong fundamental case that small cap companies are undervalued right now relative to their large cap peers. So, I started this section talking about the S&P 500 returns. What we see here is a huge valuation premium for those market cap weighted indexes, the ones that are so dominated by the Magnificent Seven. They're priced at a huge premium relative to how they typically are versus that equal weight version of the same index. So, what this combination of things tells us, where the long-term, the short-term trend, and the valuations, they all sort of agree that small caps look attractive. So we are leaning into small caps across all of our U.S. equity strategies right now in anticipation that we're going to see a big small cap phase. So, that was not the winning place to be in 2023, but we do think that that's a huge opportunity to position for in 2024. So that's really the biggest news from a size and style standpoint. I did want to mention that our stock selection actually tends to do very well in these market recovery phases. So I'm at risk here of just showing you how the sausage is made a little bit too deeply. There's a bunch of different things. It's kind of our internal shorthand for what these signals call for. But essentially what I'm showing you here is the stock selection signals that we actually use in practice when it comes to picking the stocks to fit into your portfolio. The way that it works is we kind of take a top-down approach where we set our size, style, and sector targets at the outset, and then we fill them in with attractively rated stocks. And these stock selection models are how we pick those stocks. So you can ignore almost all the numbers on this table here. Just look at this bottom row here. This is the signal that we actually use in practice. And you can see it's somewhat obscured because the S&P 500 was up 26%, and the group of stocks that our signal told us to buy was also up 26%. So you don't see that much return separation when you compare us to the market cap weighted indexes. But the way that we evaluate our own effectiveness is we take a look at the stocks that our stock selection model says to buy, and we compare them with the stocks that the model says to sell. And that differential is how we evaluate our own effectiveness on, basically, is the stock selection model doing a good job telling us which stocks to avoid and which stocks to own? And as you can see here, there is a massive differential between the buy rated group, which is for the year nearly 26%, and the sell rated group, which only returned about 9% last year. That's nearly a 17% differential between those two groups of stocks, which is historically very large. I think it's much larger than we would expect to do, but we'll certainly take it. So I wanted to make the point that when we have these types of periods where there's a lot of a big sell-off, oftentimes what happens is you see certain stocks sell off more than they should have, and the fundamentals simply don't agree, or pessimism takes hold, more so than is warranted, and so they have strong bounce back potential in a recovery. And so certainly it's the case that large cap stocks are back to their previous highs. There's still a lot of room to run within the small cap group as well. And typically we see this type of above average stock selection effectiveness last for about 2 years after a bear market. So we still expect there to be quite a bit of stock selection opportunity. And I think it's something that you might see hit the bottom line of your performance numbers as we move forward. If we're right about small caps outperforming the Magnificent Seven, I think we'll see the impact of this a little bit more strongly. So I just wanted to make that point, that Yes, we think small caps are a big opportunity right now. We also think there's above average opportunity from a stock selection standpoint too. So I think those two things have us feeling pretty good and pretty optimistic as we move forward into 2024. So that is the end of our prepared remarks here. So we're going to transition over into the Q&A. And so like we mentioned at the outset, I know some of you joined while this webinar was in progress, but if you want to participate in the Q&A, you can scan this QR code that you see on the slide here, and that will take you to a Q&A widget where you can enter questions. You can see the types of questions that everyone else has asked, and you can even upvote questions that you think are most relevant and that you want to see answered. So it looks like we do have one that is, the most popular. Before we get to that one, I did want to jump into the Q&A through the Zoom because someone did ask a question there. So the question, which I'll read here, is there are two mutual fund tickers. These are both of our, for our asset allocation clients. In some of the models, a lot of the models, we use an asset class called managed futures as a diversifying asset, and that's what these two tickers are. And the question is, with these managed futures funds, what are the plans to hold on to these and the percentage ownership in the overall portfolio? And I think I know where this question is coming from. This group of tickers did very well in 2022. Really, it was the only thing that seemed to make money. Okay, if you recall back to 2022, stocks were down, bonds were down. It seemed like, your 60-40 portfolio that was where the bonds were supposed to be the buoy of the portfolio when stocks fell off, it just didn't work. And a lot of our clients who were in a more moderate risk tolerance portfolio were invested in these managed futures funds that helped, that did their job of being the buoy of the portfolio. One of these funds was up over 20%. The other one was up over 30% year to date last year. And so they did very well. This year, it's been the opposite story where both of them are down a bit, even though the stock market has rallied quite a bit. And the thing I'll say about that is the reason why we add managed futures into our asset allocation models is because they are truly non-correlated with the major asset classes being both stocks and bonds. And it's that 0% correlate or near 0% correlation, which is why they're allocated to portfolios. They do a really great job of just performing differently than what you're getting with the rest of the portfolio. And over time, that's going to increase your returns on a risk-adjusted basis. And so in years where the market declines, they can go up in value, which they did last year. But sometimes we get the opposite, and they become the most hated asset class, like in a strong year like this one, where they're bringing negative returns to the table. I'll say that non-correlation is a feature, not a bug. And if you understand how these types of investments work, they're really truly trend following investments. So 2023 was a uniquely tricky year for any sort of trend following strategy because we had declines followed by rallies, followed by declines, followed by rallies. It was more of a zigzag path to get to 26%. So that's a tough performance. It's just a tough environment for managed futures to do well. But that sort of explains, what went on within that group. And so I think if you ask us to answer the question directly, what the plan is, we're going to continue holding them in the initial proportions that we set, because we do believe that over the long run, the non-correlation is going to add enough value to portfolio. So it looks like, Adam, you maybe had some thoughts on this one as well.
Yeah, well, I was going to say, any questions around what you hold or how much of it you should hold in the portfolio is a great conversation to have with your advisor at least, once a year or so to revisit that. I was also going to point out, Andy, 2022, there was a massive delta in favor of these alternatives while the market was down. And it was also true for that really rough stretch at the beginning of 2020. So we've got recent examples of times when there's the panic button is hit and there's these prolonged sharp sell-offs that happen in windows of time. That's when these trend following strategies really create that diversification and support the reason that they're there. So it's a good question to have with your advisor in terms of how much you hold and what the overall mix should look like. But for us, exactly, I mean, all the research we've done supports those types of alternatives, improving the risk return characteristics of the portfolio over time.
If I might add one more sort of opportunity that occurs by using multiple asset classes, is there's a rebalancing opportunity. So when an asset class does well compared to the others, the process is take some of those profits and reinvest in the lagging asset classes. So we had an opportunity to do that after 22, and we'll have an opportunity to do that again after 23. And to Adam and Andy's point, that the purpose of this is kind of long-term in nature. So there's going to be, this is exactly actually what we want to see out of this particular asset class, is something very different than what the overall equities are doing in particular.
All right, perfect. Well, let's I think there's one more question came through the Zoom, but I'm going to hop back over here to the Slido. And the top most upvoted question here, we did preload these questions with, I know we asked at registration if you had any questions for us, and so we preloaded the responses that we got through that. You can also add additional questions, again, use the QR code. But the top upvoted question here is, what is your outlook for 2024? I know I've got my thoughts on that, but Lowell, I want to give you a chance maybe to give your opinion there.
Oh, we got you on mute. There you go.
So I'll channel my first boss here, Ted Rosenberg, who had just a pat answer, which is expect the unexpected every single year. There's no crystal ball that we have here. I think the economy will drive more than anything else how stocks perform right now. That look positive, but as we all know, that can change on a dime. When the market disrupts, nobody knows, but it's actually sort of strangely, it's an exciting time for us, as we talked about earlier with our stock selection models. We do best following that disruption. So I can't tell you when it'll occur, but I know that we're going to have a really strong opportunity again whenever that occurs next. So over time, expect 10% out of the markets. Next year, it's anybody's guess.
Yeah, and add to that, for people that watch longer term trends, we have not yet broken through our previous all-time high, right? We've been flirting around it now for several months. Not too long ago, we were in a window where the market had been flat for almost the last 2 years. So it still feels like there's that disconnect between pessimism and the economy holding up really strong.
Yeah, certainly. One other thing that I know you addressed, Adam, is we had Goldman on at the beginning of the year. I know some of you on this call probably watched that webinar. They've actually since changed some of their views, actually to be more optimistic than they were when we had them on and to do our webinar. But they are still projecting that, for the S&P 500, that there's still gains to be had, even with the Magnificent Seven run up. One thing that they did note is that you can expect maybe some volatility related to the election. But to Adam's point, we really don't expect that to be a material driver of returns over the long run. So maybe there's some short-term selling that occurs just due to election news, but the best thing you can do is just let that be noise and stick with the investment strategy. All right, I'll check that one off, and I'll highlight the next one here. Looks like we did have one upvote here. So interest rates, and how that impacts market projections. So I think that there's been a huge, I'll say a pretty significant anyways, dovish heel turn from the Fed. They've been so committed to locking down inflation that every chance they got, the comments from Powell, the chairman of the Fed, Jerome Powell, was that, don't expect us to cut rates. We're still evaluating the data. Like, they're going to be super committed, very hawkish with their tone, but that's changed. So when it comes to the outlook on interest rates in market projections, again, Lowell, I'll give you a chance to get a crack at this one first. Any thoughts there?
Yeah, so the the crowd is a pretty reasonable. It's the best forecaster out there. I mean, all forecasters are fatally flawed. There's lots of embarrassment when you look back at forecasts pretty much all the time. Um, but the forecast is for interest rates to be cut. Um, I think it'd be really surprising if we didn't see at least something similar to what the market's expecting. That impacts primarily the short rates. The longer rates are going to be tied to inflation and inflation expectations. So, I think we're at a place now where we've seen them stabilized. It would be nice to see them come down. But in a stable, I'm talking about long rates now, in a stable to declining environment, that's going to be good for all of our asset class returns.
Yeah. I think so. And I think, you've looked at, I mean, this is Adam, you've been making the point this entire webinar that the economic data has held up much better than what projections were. So like the headline I love to point to occurred right at the end of 2022, and it goes something along the lines of 100% chance, like economists see 100% chance of a recession happening in 2023. And I laugh because, we're still waiting for that recession to occur in 2023 now that it's 2024. And I think, one of the things that the reason why economists were so worried about it is the Fed raised interest rates so quickly in such a short period of time that it just felt like they were going to push the economy past the breaking point. And, again, like over and over and over again, we see GDP numbers come in strong. The inflation numbers have come in better than expected. Employment has, despite the increase in rates, employment has been very low historically. So even. And so now that the Fed is, by taking that first step and actually cutting rates, which I think is expected to happen in March, they're admitting that they think that they've at least made significant progress, if not won the battle against inflation. And in fact, if you look at, like the rolling like 3-month or even 6-month inflation numbers, they're much closer or even below what the long-term average of 2% is. So I think that that's going to be an interesting storyline. I think it does support, by the way, that move to small caps and that move to growth companies. So the one thing I did not talk about in my prepared remarks was that we are leaning towards growth as well. And so typically in a falling interest rate environment, you see growth companies do better. And so we are also positioning for that. There is, when I look at the momentum signals, there is some conflicting signals there between where we expect a long-term trend to be versus the short-term trend. So due to that uncertainty, there wasn't much to say about it right now, but we do think that that's going to be the place to go. And if the Fed is serious and we do see rates begin to fall, that should be bullish for that type of positioning. All right, I'll move on to the next one here, which is world conflicts and the uncertainties that impact investment strategies. So we're seeing, quite a bit of unrest. It's more than just Ukraine. Now it's more than just Israel and Gaza. It's more than just, there's issues in the Red Sea now as well. So Lowell, I keep going back to you, but I think that, this is something that you typically do have pretty good, you're well read on and have pretty good opinions on. So these world conflicts, geopolitical risk, what would you say about that to concerned investors right now?
So I hesitate to do this, but a very politically conservative friend of mine shared a book with me years ago that talked about a thing called generational theory and the fourth turning. And he sent that to me before Ukraine and before Israel. And then we see all of these tensions, boil into war. And it was basically forecast from this book. So there's a full version, hundreds and hundreds of pages of this book, and then there's a Reader's Digest one. I encourage you to, if you're interested in this, to go with the Reader's Digest version. But basically, it's the theory is there's sort of an environment where this type of behavior becomes kind of expected, and we're seeing that now. And it's going to be rough. Like, as Andy said, it's not just one or two places. It's kind of morphing more generally. I think the big risk would be China, Taiwan. I think, Ukraine is pretty localized. Mideast is, uncomfortable because of the impact it can have on energy. But the big one that would, be a major disruptor would be, China, Taiwan. That election didn't go China's way, just recently in Taiwan. So this will be another, um, uh, very topical, all through the year. I don't see likelihoods that any of these things are going to be resolved even in, a year from now. So this is going to create tension. It's going to create volatility. But it's, unless something really dramatic um, occurs that pulls the whole world into something, it's probably not going to have a material impact at the end of the day on our investment. So, for right now, the direct answer, to this is we're keeping an eye on it, but we're kind of focused on what our normal investment opportunities, are, and say some prayers for us and people most effective getting through it.
Yeah, and I think last webinar, Andy, we put up a chart that's probably good to reshare in some fashion that showed it went back, I mean, almost 100 years, and it showed world wars, major global events that have happened and their dates and the subsequent market impact. And the net result of all of that is you saw almost a single digit up or down swing in the markets based on different things happening in the world. So the net effect of that was very similar to what we observe when we look at things like historical election cycles. It's that, things happen, we see beyond them fairly quickly. And, the market's a big machine and the economy's a big machine with a lot of inputs and a lot of resiliency. But that's something that if you go back and watch the recording of our fall 23 webinar, which was posted in October, there's a good several minute bit on that with a lot of good data points.
Yeah, certainly. And I think we can maybe, send that out when we send out our email announcing that we've posted this webinar as well. So that's a good that's a good thing to go back and check out. All right, Adam, your favorite topic. Give me
I
your
was
thoughts on
saving
the new
these questions
Bitcoin
the whole
ETFs.
time, and I knew I was going to get the Bitcoin question no matter what, and have to be mentally prepared to answer because it has been in the headlines, especially the last week when someone hacked the SEC's Twitter account. Is that what happened? They hacked it and they posted that a Bitcoin ETF was approved. They said that it was a false report, and then like the next day they came out and said, "Oh yeah, it's approved." So someone got fired at the SEC last week,
What a
but
bad day.
we are getting a lot of questions. Our general stance on Bitcoin specifically has not changed. That it's a trading asset at this point versus a use asset. It operates, in our view, very similarly to gold. It doesn't have a specific tangible value. It's very volatile, and in short spurts of time can move significantly up or down. So in terms of the role of something like a Bitcoin in the portfolio, we can't make a strong enough case yet to support that. The ETF seem to be the next natural step in its evolution. It doesn't change, in our view, the use of Bitcoin in practice in life or in a portfolio. It just democratizes it to a new level. And yeah, you're seeing a lot of debate now on who's offering it, who's not, how do you get access to it, right? Some institutions like Vanguard have put a foot down and said, we're not touching this, right? We're protecting our investors. Others are welcoming it and using it as a marketing opportunity. So I guess our thought on Bitcoin has not changed. Our thought on the ETFs are this was just inevitably going to happen. ETFs in general have broadened substantially. There's all kinds of levered ETFs that go long and short the market. There's ETFs that track all different types of crazy categories now. So it's a lot of good marketing and not much beyond that. Do you guys have any other opinions in that regard?
Certainly. So I think this dovetails with the question below it, which is honestly this one I think is like the single most difficult question I think anyone's ever asked in one of these Q&As is to describe what a cryptocurrency is using small words. And I think it's like it's very, very difficult to do. And I'll take this as a moment not to try to tackle that, but just to simply say, it's okay not to own Bitcoin. There's, you mentioned Vanguard putting their foot down and not allowing any of it on their platform, but there's that adage that you should really understand what you own, and if you're having a hard time understanding what a cryptocurrency is, what Bitcoin is, what any of these things are, it's probably best just to avoid it. You don't have to own it. I'm sure you still hear about friends and family and coworkers or whoever having some sort of fantastic return from Bitcoin. And it's easier than ever now that you can just go into your brokerage account and buy one of these Bitcoin ETFs. But, I don't think you're missing out. What you're missing out on are the potential for very high returns, but also an insane amount of risk and volatility. I actually wrote something about this a few years ago, back when cryptocurrency was first, becoming part of the public zeitgeist. And what you could expect out of it, if we just deconstruct it and think of Bitcoin or all these cryptos as an asset class, same way you think about stocks and bonds, is you can expect there to be a lot of risk. You will need to have a very high risk tolerance to have any sort of meaningful allocation to it whatsoever. There will be times when there are fantastic returns, and there will be times when you're in a 90% drawdown. I think that's just what you can expect. So typically we think of risks as stocks as being the risk asset that has the highest long-term returns, but also the most volatility. Bitcoin is an order of magnitude more volatility. So if sometimes stocks make you queasy and make and if it's difficult for you to stay invested in stocks, certainly it's okay not to own any of these things.
And shockingly, I want to whack at this too. This reminds me a lot of .com 25 years ago. There was new technology that was, getting a lot of excitement. The technology that underlies currencies, blockchain is actually going to be an important, new technology that will make financial transactions better and more secure, in the future. So there's a piece of it that's great, just like there's a piece of .com that was very important and made a big impact on just everybody's interactions in the world. But there's a lot of speculative pieces that will wind up going to zero. And so a lot of these cryptocurrencies, the value is basically just on what somebody else is willing to pay for it. There's nothing tangible there. So it can be a spectacular asset from a speculative standpoint if you can play those highs and lows that occur with all that volatility. But it's just not something that you can point to and say, yes, there's inherent value in one of those things. And it sort of ties really to the last question there about gold and silver, where it's the same thing. Gold and silver become very popular during times of distress. Sort of Bitcoin is kind of like acting that same way now. But as a long-term investment, it has a very poor risk return profile. So it's not an asset class that we've ever been enthusiastic about.
Yeah, and there's a fundamental use test that gets applied to things like stocks and bonds, where when you look behind the curtains, there's something tangible that produces cash flow and profits. And with tying it in, I like that analogy to gold. I often ask, because we get questions all the time: should we buy gold bars? Should we store gold in the house? Things are looking tough, and if your worst case scenario played out in this apocalypse scenario happened, you're not taking your gold bar up to the grocery store and shaving off pieces of it to kind of get yourself by. So it's more of a feeling of comfort and safety on the gold front. And on the Bitcoin front, it's seen to be a return chasing mechanism where it sounds really cool. The blockchain agree there's going to be a lot of innovation there, but at the end of the day, no one can quite put their finger on how to actually transact or do something with it.
Yeah, it's like far slower than Visa as a transaction tool. So it's tricky. But again, It's okay not to own it. That's just going to be the thing that I go back to. All right, so I'll mark those off. I want to get to this. There's one question remaining on the Slido here. We did have one other question come through the Zoom Q&A, and the question was, are you looking into U.S. small cap or global? And the answer is both. We think the opportunity specifically in the U.S. that's what we're focused on, because we do that, like our U.S. equity strategy specifically leans into small caps at certain times, this being one of them. When it comes to international investing, we acknowledge that our expertise lies in the US side of things. And so we actually outsource the investing to ETFs and mutual funds when it comes to international investing. But it isn't to say that we just punt on our due diligence there. We've looked at a large number of international, investments, and the one that we settled on is one that it lands philosophically with where we want to be, and with where the academic research says there's return premiums. And so the international funds that we use systematically overweight smaller companies as well, really kind of at all times, both in the international developed and emerging market space. So it is accurate to say that small cap tilt is something that we're leaning into globally right now. And so the final question here is I included this one here. This is one that we got through the sign up, and I wanted to include it because it's something that I've received from clients. I think that we've seen from clients where there does seem to be this disconnect, Adam, that you were talking about, where economists, the vibes, if you will, just like the feeling about the market has been really negative, even though we've seen the stock market rally 26%, and we've seen some of the economic data come in systematically better than expected. And I think it's important to just understand here that people come from all different parts of the country, and certainly there are some parts of the country where conditions are better, and there are some parts of the country where conditions are worse. And depending on where you are, your experience may be very different from what the headline economic numbers show. And so if you've got this bearish view towards where we are as an economy, I totally understand it. It's always scary times. There's all sorts of scary headlines that can certainly 8-9% inflation is not a fun thing to go through. There's all sorts of there's industries that are dying and things are moving, all the time. So I did want to, though, maybe try to paint a little bit of a more optimistic picture here. So if we look at, I'm trying to go back to my slides here now. We mentioned again that we worked with Goldman to do a webinar. They just in the past week, I think earlier this week, released a research report, which was 10 reasons why they worry less about growth risks than what is maybe the consensus out there of economists. And there's 10 different things that they have here. Now, I'm not going to hit on all 10. I can certainly send you a summary of this research report at the end of this. But basically they view a lot of the economic data has continued to come in strong, and they think that's really going to continue. So the consumer has been resilient. They don't see that changing. You may have seen headlines about delinquency rates and default rates increasing, and certainly they are from where they were, which were these really artificially very low levels. It's becoming more normal, what we would expect over the long term, and that's not necessarily a bad thing. Some people are expecting the labor market to deteriorate, but again, they were expecting that to happen at the beginning of last year as well, and it just hasn't happened. So people still have jobs, and even if unemployment rises from where it is now to say 4%, that's still very strong over the long term. You hear about rising corporate bankruptcies, and again, we're just getting back to pre-pandemic levels. Nothing that's a big cause for concern. One of the things that I've heard people talk about is, there's these huge losses coming with office buildings. You go to any major downtown area, and there's vacancies everywhere. But Goldman makes the point that office loans, made a little typo here, that should say office loans only account 2 to 3% of bank loan portfolios. So even if there are significant losses, it shouldn't be this big shock. The bank should be able to absorb it. And talking about banks, after what happened with Silicon Valley Bank in the spring, there was fear that there's going to be this huge credit crunch and people just simply weren't going to get access to credit. And that, again, it's been not as bad as what was once feared. And then the final point here is, there's always been this fear of expect the unexpected, as Lowell said. Something's going to come out of left field. The Fed raised rates too fast, really fast, really high in a short period of time. And nothing major anyway, seemed to have broken. And Goldman thinks that it's much less likely that we do see that left field thing happen, because if it was going to break, it probably would have broken during the aggressive rate hikes. Now that we've got some space from that, there's been time to adjust to where things are now. So I just wanted to make that point. Like, I get it that, depending on where, what you're reading, really any major news organization is always going to be sending you the negative headlines, because that's what generates the clicks. But, Goldman Sachs, they kind of put their money where their mouth is. And if their analysts are more optimistic, I think that's, to me, I'll put more value in that than, simply what some, blogger is saying about their opinion there. So I just wanted to make that message. Adam, I know you mentioned this a couple times about the economic data being better than, maybe what people were expecting. Do you have anything to add to that?
Yeah, and I'll just close and say, I mean, that we measure both things, right? You can measure sentiment and how people feel about what's happening, and you can measure what's actually happening. And we had essentially a top quartile economy last year and a bottom quartile sentiment. So it was like on both ends of the pole, we were straddling, a really great environment on paper against people feeling really negatively on paper, and that created a really unique situation. And I'd say the sentiment piece hasn't totally resolved itself, so people still don't feel great about what's happening. They feel better, but they don't feel great, and that's helping siphon off some of the euphoria feeling in the market. So I think we broke a record, almost an hour.
There we go. Yeah, looks like there's still 44 of you who are with us, which is near where we peaked from an audience standpoint. So we really do appreciate everyone joining us. It ended up being a great year in 2023, and we hope that those returns continue in 2024. So, unless anyone else has any parting thoughts, we appreciate everyone joining us today.